This week on Finity we uncover the hidden secrets of the world's markets. From daring voyages of the 1600s trading ships to the cutting-edge strategies of AI-driven investing, we explore how human ambition has shaped wealth, power, and opportunity across centuries. Markets are more than numbers, they are stories, risks, and human behavior, repeated across time. What can the lessons of merchants, bubbles, and high-stakes trades teach us today? Let's dive in and uncover the secrets. Chapter 1. The birth of modern trade, 1600 to 1700s. In the early 1600s, Europe was transforming. Trade wasn't just business, it was adventure, politics, and power. Merchants risked everything to expand their influence. Ships like the Dutch East India Companies weren't just carrying spices, they carried wealth, power, and ideas across oceans. Imagine a single voyage, months at sea, storms, pirates, mutiny, and yet, if successful, it could make a merchant richer than a king. This hunger for wealth and control created one of the earliest forms of shared investment, pooling money into voyages in exchange for a share of profits or losses. This was the first version of public trading. Merchants meticulously recorded every detail of their transactions, from cargo inventories to crew payments. These ledgers were early forms of financial transparency, allowing investors to trust their partners. Some merchants even kept diaries describing their strategies and observations of competitors. Trade was a dangerous game. A single miscalculation, a pirate attack, a misjudged weather pattern, or a delayed shipment could wipe out an entire year's earnings. Yet, the potential rewards drove innovation, risk management, and the very concept of investment itself. The foundations of modern finance were quietly being laid on the decks of wooden ships and in the offices of merchants across Europe. Chapter 2. Early stock exchanges and risk, 1700 to 1800s. By the 1700s, the Amsterdam Stock Exchange became the world's first official trading floor. Investors gathered to buy and sell shares, shouting bids under candlelight. Speculation turned to obsession, and the infamous South Sea Bubble in England showed how greed could destroy fortunes overnight. Yet human ambition never stops. It adapts, innovates, and finds new ways to pursue opportunity. The dream of wealth persisted, evolving into the modern concept of stock trading. Risk, reward, and timing became the pillars of investment. During this period, investors began developing early strategies to predict market movements. Some observed trade winds in commodity prices. Others studied public sentiment and rumors in taverns and coffee houses. These were the first attempts to understand market psychology, a practice that continues to this day. Markets became reflections of human behavior. Patterns emerged. Fear and greed dominated decision-making, often overriding logic. Early investors realized that understanding both the tangible assets and the psychology of other traders could create a significant edge. This dual insight, economics and human behavior, remains a critical component of successful investing today. Chapter 3. The Industrial Revolution, 1800 to 1900s. The Industrial Revolution transformed the world. Steam engines, factories, and railroads required massive capital. The stock market became the engine of growth, offering ordinary citizens access to extraordinary ventures. Wealth concentration rose, speculation grew, and markets mirrored human emotion. Investors learned that timing, insight, and foresight could create fortunes overnight. New financial instruments emerged, such as bonds, diversified portfolios, and joint stock companies. These tools allowed investors to manage risk more effectively while funding large-scale industrial projects. Entrepreneurs could now scale operations like never before, backed by financial markets. During this era, cities and towns expanded alongside commerce. Railway expansions connected rural areas to urban centers, opening up new markets and creating opportunities for investors to profit from growth in almost every sector. The Industrial Revolution didn't just change technology, it changed the way people thought about money, investment, and opportunity. Chapter 4. Psychology of Markets, 1900 to 2000s. In the 20th century, markets became dominated by psychology. Fear, greed, and herd behavior drove crashes and booms. The 1929 Wall Street crash wiped out billions, changing lives and economies around the globe. Decades later, the dot-com bubble reminded the world that emotional behavior in trading remains constant, even in modern times. Investors learned that understanding market sentiment is as important as analyzing balance sheets. Modern behavioral economics stems from this era, emphasizing that rationality is often secondary to emotion. Today, AI studies the same patterns, analyzing millions of transactions to detect trends before humans can. Yet even with advanced algorithms, human emotion remains a core driver. Recognizing this is key to success, whether investing in a startup, commodities, or global markets. Chapter 5. Rise of Computers and Algorithmic Trading. The late 20th century introduced computers and automation. Algorithmic trading transformed markets. Trades that once took hours now happen in milliseconds. Complex formulas and neural networks dominate the financial landscape. Those who adopted early technology gained an edge, those who didn't fell behind. Machines became extensions of human ambition, speeding decisions, reducing emotional error, and opening new frontiers for investment. Investors began combining traditional analysis with automated trading systems. Rules-based approaches and pattern recognition became central to strategy. Algorithms allowed for higher frequency trading, greater portfolio diversification, and the ability to react instantly to global events. These developments changed the game completely, merging human insight with machine speed. Chapter 6. AI and Modern Investing. Today, AI analyzes more than numbers. It reads social sentiment, global events, and online trends to predict market behavior. The lessons of the 1600s, risk, diversification, and timing, still apply, now amplified by technology. Imagine machines spotting opportunities before humans, reacting instantly, yet still guided by human-designed strategies. The spirit of the old merchant, curiosity, ambition, and insight, lives on in every AI-driven trade. AI models scan billions of transactions, from corporate earnings reports to tweets, news articles, and geopolitical events. They identify correlations and trends invisible to human analysts. Investors who understand both history and AI leverage are best positioned to capitalize on opportunities while mitigating risk. Even with AI, understanding market cycles, investor psychology, and historical trends gives humans an edge. Machines may process data faster, but wisdom comes from experience, analysis, and judgment cultivated over centuries. Lessons for investors: history repeats itself. Human behavior remains constant, greed, fear, and hope shape markets more than numbers ever will. The greatest investors aren't the fastest or the smartest, they're the most patient. They study history, understand patterns, and act with insight. From the 1600s trading ships to AI algorithms today, the secret of wealth creation remains unchanged: anticipation, action, and understanding the rules. The most successful strategies combine knowledge of past market cycles, awareness of human behavior, and disciplined execution. Investors who ignore these lessons are often doomed to repeat the mistakes of the past. Thanks for watching. If you enjoyed this deep dive, subscribe and turn on notifications so you never miss the next episode. Share your thoughts in the comments. Do you think AI can master the markets, or will human instinct always lead? Share this video with friends who love uncovering hidden truths. Until next time, keep learning, keep exploring, and keep your curiosity alive.